Hello everyone and welcome to this week's FX Update. My name's Craig Earlham, Senior Market Analyst at Oanda. Thank you all very much for joining us again. It's always great to have you on and do these live sessions. The benefit of these obviously is both for me to give you some live analysis of the charts and give some insight into what's happening, but also so you can ask questions and ask me to take a look at anything else which I may not have already covered. So hopefully you guys can get as much out of this as possible, and I can be as useful as possible in the next half hour. Naturally, we are going to be touching on some of the same topics. One, most notably, unfortunately, thanks to a 2-week extension, over the course of the next half an hour. So I'm sorry if not everything applies to all of you, but hopefully everyone here will be able to get something out of this session. Now, what you should be able to see in front of you right now is the Market Pulse website. That's where myself and my colleagues post all of our analysis on a daily basis. It's also where you'll be able to find the recording for this webinar later on today, and it's also where you'll find the economic calendar. The economic calendar, which myself and the other guys here and many other obviously traders around the world use every day in order to give some insight into what sort of the key events, the key known events that are upcoming that could influence our trading. Now, I'm going to note this down by the countries or the currencies which I am planning to take a look at during this session. If I do miss any off, then by all means do just speak up and I will look to include it. And even if it's not something I always take a look at myself per se, I'm always happy to at least give it a shot and offer any insight that I do have. I'm only interested in medium or higher events simply because there's a lot of economic data that you get out throughout the week, which largely goes unnoticed from a market's perspective. So that leaves us with this. Now, first thing to note is it looks like there's a lot of stuff here, but from my perspective, this is still quite a quiet week. We are still very politically dominated from a market's perspective right now. That being said, I think last Friday was a prime example of where the data can really have an outsized impact during potentially quite vulnerable times for the markets. We saw that German PMI on Friday. And I can actually expand the dates out here to cover it. I typically try to use the session to look ahead more so than behind, but I think this was just quite a prime example of when a number did spook the markets. And it was this manufacturing PMI from Germany. As you can see, it fell from 48. It was expected to fall to 47.6. It fell to 44.7. And that really shook the markets. It didn't just prompt a sell-off in the euro, and it did prompt a big sell-off in the euro. It triggered a sell-off in European equity markets. It then triggered a sell-off in US equity futures as well. So it became far more widespread. Triggered a lot of risk aversion heading into the end of the day, which was which was followed by further risk aversion when the US PMIs were also soft. The reason why this was so significant was because the triggers for the drop-off, the fact that it was a 6.5-year low was obviously quite a worry from a trader's perspective. But it was also the fact that what we were looking at here was signs that the global economy is slowing, the fact that export orders were slowing, the fact that employment for the first time in 3 years had gone into decline rather than rising, the fact that the reasons touted were global reasons, not domestic. So yeah, the car industry slowing does tend to have an outsized impact on Germany, but it also has an impact on Italy. It has an impact on other auto-producing countries. So that is obviously more broad-based, and it's not just to do with something that's happening in Germany. Yes, things like diesel emissions testing is having an outsized impact on the industry, but also Brexit is having an impact on the industry. Also, Chinese demand is having an impact on the industry. Part of that, I believe, is to do with subsidies which have been removed, and therefore incentivization for buying new cars has diminished, and that is having a big impact on numerous car manufacturers. Jaguar Land Rover, I think, is one that's been significantly hurt by these changes in China. But there's also things like the trade war between the US and China and the impact that's having on global sentiment. The fact that Europe could be targeted next, particularly again the auto manufacturing. All of these factors are really playing into it, and this is at a time when central banks are loosening not loosening there, but they're not tightening monetary policy anymore, so they're taking a far more dovish stance, and global growth is expected to slow, which is why we're seeing central banks take this approach. So something as simple as the manufacturing PMI from Germany really did trigger a lot of risk aversion towards the back end of last week. So there is going to be a lot of attention on the economic data as well for further signs that this is becoming more ingrained in various different economies. Interestingly, though, the IFO number at the start of this week was not quite so dour. The business climate was 99.6. Again, this isn't a particularly strong number, and it very much continues the downward trend which we've been on since the start of 2018. But at the same time, it's not quite as significant as what we saw on Friday, and it was also expectation beating, which is always significant. Again, the expectations component of this is particularly worrying because it doesn't suggest that anything's going to improve. But again, at the start of the week's been quite light on a data perspective. We've just had some housing data at the US, which again is a little bit worrying, shall I say. The fact that we seem to be plateauing here, the fact that we are seeing some slightly more negative figures, again, this just adds to the concerns. When we start to see more and more bad data, it doesn't have to be particularly bad data, but disappointment after disappointment after disappointment does tend to wear on investor sentiment. And then all of a sudden negativity can beget negativity, and so on and so forth. We've got the RBNZ statement overnight, again, in light of everything that's happening, in light of the Fed last week opting for a far more dovish assessment than I think many were expecting, including myself, taking any rate hikes off the table this year and allowing for only one next year. I say allowing, it's an expectation, they can change at any point. And also all the central banks as well. I think many people are expecting the RBNZ to also adopt a softer stance, shall we say. We'll also hear from a number of ECB policymakers tomorrow. And again, the ECB already acted a couple of weeks ago and adopted that far more dovish stance in line with what we saw from the Fed as well. So maybe not too many surprises from that perspective. But 5 speeches tomorrow from various ECB officials. I think traders will sit up and take notice. Then on Thursday, we have the GDP data from the US for Q4. Worth noting, of course, that this is a third revised figure now. So for it to be newsworthy, we'll have to see a significant revision here. We've also got a scattering of other pieces of data, things like jobless claims and personal consumption expenditures, which again, more noteworthy than market hitting, I guess. But in light of what everything we've seen, perhaps this is something that people now start to pay a bit more attention to. For example, above expectations, jobless claims at 250, for example, will that be enough to actually stir further fuel the flames of these recession fears? We'll have to wait and see. And of course, we've got UK GDP on Friday as well. German unemployment, again, in light of that PMI, very much will be of interest, especially as the rate's expected currently to drop to 4.9%. There was an element of the services PMI offsetting some of the manufacturing disappointments, but not entirely. And so the fact that we're expecting a drop in unemployment here is quite interesting. UK GDP, again, probably playing second fiddle to Brexit right now. And then US inflation data, income and spending, I always think is a really interesting economic release here. It covers so many things, including the Fed's actual mandated inflation figure. So it's something I always keep a close eye on. And then the University of Michigan consumer sentiment as well is one that I always personally pay close attention to. But as you can see, we've also got a scattering of central bank speakers, so that's worth keeping a close eye on as well. So like it's one of these weeks where I think a number of these data points would be largely ignored 2 weeks ago, 3 weeks ago, 4 weeks ago. But in light of what's happened, I think these are going to attract a lot more scrutiny. And therefore the market impact could be more significant than it would have otherwise been. The other thing that's happened this week, which is something that I can't necessarily show you on a chart, but I will try to bring up at the next webinar. I'll try and find a good chart for it at the next webinar, is the yield curve. Now, for those of you who are not aware, the US yield curve is basically, it plots out the yield on 1 month, 3 month, and 6 month notes, and then 1 year, 5 year, 3 year, I think, and 10 year and 30 year treasuries. And it plots it out as basically a line chart, just showing the different yields for each of those maturities. And what you typically expect to see is the line would gravitate upwards. Simple reason being that people would expect the term premium on the returns that they can expect from holding these particular bonds. Obvious reasons, really: inflation, risk of lending over a longer term period. And what we've actually seen now over the last 6 months or so is that yield curve has become inverted. Now, an inversion can happen for a number of reasons. It can happen, for example, if the Fed was buying a number of bonds, 5-year bonds, for example, and was concentrating its buying in that area, then that would drag the yield down in that area. So that could cause an inversion. They don't typically tend to do that, to be honest, though, but just as an example of why it could happen. We could also see a slight inversion if people are expecting the economy to flatten off, maybe even have a single rate cut over the next few years. That could potentially cause an inversion. So people don't tend to pay too much attention to slight inversions in the yield curve. When we see more significant inversions in the yield curve, where, for example, a 5-year treasury is yielding less than a 1-year treasury, then that is when we start to hear a lot more fears about a potential recession. And it's always the 2s and 10s, so an inversion between the 2-year and the 10-year that has typically in the past been seen as a warning of an impending recession. Now, impending could be a 12 months, 24 months, but it typically is what is seen as being a recession indicator, and we've actually hit that now. I think it's the 6 month to 10-year inversion at this stage, and that's got people in a bit of a tizzy. It's got people fearing a recession. So on Friday, when we had the German data, we had the US data, and we had that inverted yield curve lengthen. Then that's why we saw a big declines in the US equity markets on Friday. And while we haven't seen further major declines at the start of this week, the underlying jitters are very much still there. And that may continue to be a common feature now in the markets over the coming weeks. If we see further big down days in the markets, again, fear begets fear, bad news and bad news, and so on and so forth. So another ongoing story where you're not going to see economic releases per se, but another ongoing story which I certainly think is worth paying close attention to. With that, we will move on to the charts. I'm obviously not going to go through an entire webinar without talking about Brexit, but let's get to a cable chart, and then I can cover it. What the latest is with this farcical event at this stage. Looking at euro dollar, we haven't really moved on from where we stood previously. Yes, we had this dip. We've had a couple of dips below this support area around 113 now, but there's no denying that 113 continues to be a notable support zone. The area around 113 is a notable support zone. On this particular chart, we're hitting those levels again, and we're steadying around those levels. If we do see a break below here, I don't think it's going to cause any major panic. 112.50 has acted as support around here before, even 112. If we start to break below all of these lows, then below 112s, then potentially you start to see a little bit more negativity forming here. But even then, around these kind of 111, 111.50s, we've got historic support as well. So it would suggest longer term weakness, obviously. But I don't think we're talking big major drop-offs here. If we drop below 112, I'm not saying we're going to move all the way back to 108, 105, for example. This has been a long, gradual decline, and there's nothing for me that suggests we're going to see that change anytime soon. Potentially, more important for me would be a break above 115, 115.50, say, because that would suggest an actual trend change. So that could potentially be something that gathers momentum. But these moves to the downside, as you can see here, momentum is not gaining. Momentum is declining, if anything. So that wouldn't suggest to me that this is going to pick up any steam. Moving on to our Brexit currency, the pound. Now, what's happened since our Brexit webinar last week? Well, I mean, a week feels like such a long time in Brexit at this stage. I think the most notable thing that we've seen happen was on Monday. Now, on Monday, the UK Parliament voted on an amendment to Theresa May's motion to back Parliament taking control of proceedings for one day this week, and that day is Wednesday. And the reason behind this is because they want to hold a series of indicative votes. The argument in Parliament is we have had 2 votes on Theresa May's deal. It's been heavily rejected on both occasions, once by the largest margin ever in Parliament. And therefore, continually having more votes on this is not the best use of Parliament's time, and that's time that we are fast running out of, even in the event, even despite the fact that we have had been given an extension by the EU. The terms of that extension are the UK will have until the 12th of April to back Theresa May's plan, or another plan that has the backing of the EU, and in that event, it can leave on the 22nd of May. Now, do you know what? I've always said that I'm not really a fan of timetables, and I'm not. They tend to expire very quickly. But for the sake of this, I have just put together just a couple of little things here, which hopefully may help show things a little better here, which will hopefully now be popping up on your screen. So this is the timetable, the known timetable for the next few months. So as you can see here, on the 27th of March, that's tomorrow, lawmakers will take control of parliamentary timetable and a series of indicative votes, allowing MPs the opportunity to rally behind a plan for how to proceed. Now, it's not clear at this moment exactly how that process is going to go. So it's hard to really make bold predictions on what the outcome is going to be. It has been suggested that this may not just be a case of vote on this deal, then vote on that deal, then vote on another, that it's going to be something more aligned with preference. And what the benefit of that would be that we do eventually end up with a majority. So if you think of the way, for example, French elections work, in that if no party gains a majority in the first round, then one party or numerous parties, can't remember now, it's been a long time since the French election, is removed, being the least supported. We have another round of voting, and we keep doing the same thing until one party gathers a majority of the votes. So I think it's something along those lines, but potentially with less continuous rounds of voting, that will be adopted for this vote tomorrow. But again, that's not something that's been confirmed at this stage, but that is what is being speculated, at least. The idea being that consensus is built around one particular plan. What those plans will be, how many things will be on offer, whether May's deal will be included, is another thing which I'm sure we'll find out in the next 24 hours. But that should at least make the session tomorrow in Parliament different, and it should make it a little bit more interesting. What are they going to rally around? The important thing again here is that nothing about this vote is binding. So Theresa May has already suggested that she may take note of it, but not act on it at all, especially if she thinks it's something that the EU will not go for. Then March 29th is no longer the exit date, as I've already mentioned. That's now been an extension has been agreed. That new extension takes us to April 12th. If the UK backs Theresa May's deal or an alternative, it'll leave on the 22nd of May. If not, the UK can leave without a deal or agree another extension with the EU and hold European elections. The European elections is really effectively what set that deadline date, because the UK must plan for European elections after that date, which is why that arbitrary 12th of April date has appeared. But ultimately, what this means is that the April 12th could be the new potential no-deal date, although as we've seen, and we'll probably see tomorrow in Parliament, there is no appetite for a no-deal Brexit. On April 18th, the EU Parliament is dissolved. It's its last sitting session. And from then until July the 2nd, no Brexit deal could be ratified. Again, that stresses the importance of why the April the 12th really is a deadline, because ultimately this deal can't be actually ratified. So you'd have to extension would have to go beyond July the 2nd. On the 22nd of May, the UK leaves the EU if a deal is approved by or on April the 12th. Then you've got the 23rd to the 26th of May. That's the European parliamentary elections. And on July the 2nd, new EU Parliament sits for the first time. Whether that includes the UK officials within that will depend on how the next 2 or 3 weeks does play out. So that leaves us with a few different scenarios on the table. This has been extended from what we had previously on the website because I feel like other options have become slightly more plausible. There's Theresa May's deal, which granted has been defeated twice, but could return, and I think probably will return at least for a third vote. We have no deal, which the date for which is now the April the 12th, at which point, if no agreement is made with the EU and the law in the UK isn't changed, would become the new default date. There's an alternative deal, which I'm sure we'll find a lot out about tomorrow in the parliamentary vote, if Parliament actually does favour an alternative, of which there are many. There is Norway Plus, there is Canada-style agreement, there is Jeremy Corbyn and the Labour parties, a customs union with partial single market access alternative, and numerous more really. It depends on how many are proposed ahead of the vote tomorrow. Then there's the second referendum. There's little support in Parliament for this at the moment. We saw from the vote a couple of weeks ago that it didn't gather too many votes at all, but that was because the Labour Party refused to back it because its priority is still a general election, which at the moment, again, there's no actual appetite for in Parliament. You would think that we will see the true appetite for a second referendum potentially in this series of votes tomorrow. And then there is extension of Article 50. And it's important to note that extension of Article 50 is not an alternative option to any of those above. It just could precede any of them. And the extent that it could be extended is undetermined because it's simply determined by how long the EU wants to go along with it and the reasons the UK gives for wanting to extend. So I hope that that provided that little bit of extra colour on the Brexit situation and the key dates. But again, this is such a fluid situation that it wouldn't surprise me if by the end of this webinar we've already seen that expire. So it's worth bearing that in mind. But that, as it stands, they are the key dates and they are the most plausible outcomes, I guess, from my perspective. In terms of what this means for the currency, it's nothing really. We're still between 130 and 133, range highs and lows. We haven't broken in either direction. We haven't broken below 130 because no deal is no more plausible. We haven't broken above 133 because we haven't got a deal. And while we could potentially break above here if we do get a long extension or a second referendum gathers pace, or the revoke Article 50 petition, which has appeared online. For those who have seen it, this is a petition that's been set up by, I'm not actually sure who it's been set up by, but basically there's a petition been set up to try and basically stop the UK leaving the EU, revoke Article 50 and stay in the EU. Now, it's been suggested that unless this reaches 17.41 million signatures, then this isn't something that's going to be taken seriously in the Commons. To be honest, I'd even be surprised if it is then. It's currently at what, just shy of 6 million, so there's still an awfully long way to go. It has gathered a lot of signatures in its early days so far, but whether that momentum will continue, we'll have to wait and see. It will be interesting though if that does start to approach the 17 million mark, even 14, 15, 16 million, if it actually starts to have an impact on sterling. Because we'll remember that prior to the referendum, we started to see some obscure things actually having an impact on sterling. One of them was the betting odds on Britain to leave or remain. So we've seen obscure things or less common things have an impact on the currency before. So it wouldn't be an enormous surprise to see something like a petition closing in on the number that's voted to leave the EU, asking the UK to stay in the EU if that started to have an impact. Certainly something I'll be keeping a close eye on anyway. But at this moment in time, 133 remains the upside, 130 the downside. This takes us to euro sterling. There's not really too much change here either. Like, we've still got just a shy of 85 to the downside. We've got 87 to the upside. We've seen a lot of volatility in between. We could potentially, I think there's more chance of moving below the 85s here than there is, for example, of moving above 133s in cable, just because we've seen long-term support broken in this, which we haven't seen in the other chart in particular. And this side just seems to have slightly outsized moves at this moment in time. But the real long-term support now has become these kind of 84s, 83s, where we've got long-term support back here. Momentum clearly to the downside with this. And I think it's worth noting this is being driven by two things. And you can see the big sell-off we saw in the pair on Friday, which is associated with that German number. So there is the Brexit situation, which is having an impact on this, but also those weaker European numbers, Germany, etc., is also a major drag here. So that's why I think this is having an outsized move compared to, for example, cable. Now, Aussie's interesting because we continue to see the floor around 70, 71. But momentum was clearly to the downside. Not massive momentum, but usually when you have a floor and you have a series of lower highs, that would suggest that the bears are gaining control. What we've actually seen now in the last week is we've seen a couple of attempts to break above this kind of falling trend line. Again, it's not a solid trend line. There's only two or three touches here. But we've seen an attempt to break above here, and now we're actually trading above here today. I'm not majorly bullish, to be honest, at this stage, despite that, simply because there's not too many touches. And for me, we've still got a series of lower highs. So therefore, that still is more significant. If we can break through 72, then I'll become what then this will start to look a lot more interesting for me. And again, if we can break through 72, 50, 73, a lot more interesting again, because then we've taken out a series of previous highs and a 200, 233 day simple moving average. That would suggest a shift to me. But at this moment in time, this is still just something that interests rather than something that looks hugely significant. And again, obviously, a break above like these kind of 73, 50, 74s then starts to look very interesting indeed, because this is like long-term resistance and support. So there's a series of potential upside breakouts here that would be of interest to me. Obviously, if we rotate to the downside and go through 70, then that's obviously significant as well. Dollar CAD's continuing a nice climb higher. We will remember from previous webinars that we've rotated off the 61.8 fib here, the bottom of the rising channel in the 200 and 233 day simple moving average band, and we've rotated higher from this point. Since then, we've broken out, made new highs. We've broken through an imperfect slanted inverse head and shoulders and made new highs here. So on that note, I'm going to remove that now because I just think it's making the chart a little bit noisy. And I'm just going to add this one here. And you can see that following the breakout of the inverse head and shoulders, we came back 50% of the move, and now we've rotated higher again. So again, another nice little bullish signal. We have failed to make new highs at this stage, which I do find quite interesting. Potentially something we can see consolidation in the near term. But the breakout of this inverse head and shoulders does give us one of those possible price projections, and I stress possible, but would indicate a move back towards these previous highs. So that would suggest that this move isn't over. The bounce off the 50 fib and rotation higher would potentially suggest that this is that we're in a bullish phase here. We did only see one down day yesterday. The thing that always worries me is the fact that it fell just shy of the previous high. And when people are selling just shy of the previous highs, it doesn't really signal too much confidence. But there is potential at times to read too much into a single daily candle. And there's no denying that over the course of the last 3 or 4 days, momentum is very much with the bulls. If we can break through these previous highs, and we can do so while gathering momentum, I'm sure that will add a lot more confidence. Sterling CAD, much like many of the other sterling pairs, is still in consolidation, is still in awaiting breakout mode, very much to the top end of this. But as we've seen with dollar CAD, we're looking at a slightly softer Canadian dollar right now. We've seen a bit of the steam come out of the oil market, which could potentially be a factor in all of this as well. The oil market, we've seen the steam come out of it because of global growth concerns. It's very basic economics here. If the global economy is going to slow, then you would assume that that's going to impact demand for something like oil. And if we see lower demand, then prices tend to fall. That is a very simplistic, obviously, summary of it, because there's so many different factors affecting it. But there's no denying that when we did see the market sell off on Friday, oil sold off as well. That wasn't a coincidence. And that typically has a negative impact on the Canadian dollar, which is why we saw the pound gain quite considerably against the Canadian dollar on Friday. So again, this is one of those scenarios where the rally in the pound is partly to do with the fact that we are seeing a bit more Brexit optimism on the back of the potential for a softer Brexit, less potential for a no-deal Brexit, even if we haven't got an actual deal yet. But it's also a Canadian dollar weakness as well. If we can break through those highs, then the next area of interest for me becomes around these kind of 180, 180.50s. 180 because it's a big psychological level, and 180.50 just because these are the kind of peaks and lows here. The last time we were trading at these levels, and obviously then above here, the kind of 184s where we peaked at last time. A breakthrough here as well, especially if we see a sharp break, would also take out this kind of rising channel this long-term rising channel. Again, this isn't an overly significant channel. It's just a channel area that has offered support and resistance on numerous occasions, really, since October 2016. So it's just an area of interest for me. I wouldn't even be surprised if we kind of enter into this channel and slowly make our way higher. Something like that wouldn't really surprise me, but a break through it could potentially be a very bullish signal. Kiwi dollar, not much has changed really here. This still looks a little bit bullish. The 50 fib has continued to hold as resistance for some time. But the fact that we keep taking another run at it, another run at it, while making higher lows, that could potentially be a bullish signal for me. If we do take a run through here and we can break through 70, then things start to look quite bullish once again. 70.50 would be the next test, and a breakthrough here, and all of a sudden, I think the kind of 71.50, 72 starts to look quite interesting. Getting a bit ahead of ourselves, but this, for me, is a bullish setup. And we're just waiting for that little bit of a breakout, which would give us a little bit of encouragement. But there are a number of resistance levels beyond this, and technically it's just quite a nice chart, to be honest. Wrap things up as ever with the yen pairs, and I'm sorry that I've run over. There was just once again a lot to catch up on, and Brexit does take many hours out of my day, and as you've become, I'm sure, very aware, many minutes out of the webinar to catch everyone up. Unfortunately, it's a very complicated process at times. It can be an extremely boring process at times, but it's always best to try and at least do my very best to explain the situation in a way that just keeps everyone who's not following so closely abreast of everything that's going on. Dollar yen is well, I mean, we've seen this come off in two periods, really. The first one was on Wednesday, following the Fed minutes, which was a dollar negative event, obviously being much more dovish than we were expecting. That naturally weighed on the US dollar, fewer rate hikes, for example. And then on Friday, in very risk-averse markets, was a very yen bullish event. So here we have Wednesday, and here we have Friday. What that's done is it's brought us back towards these kind of 110 levels. 110, which has historically been a notable, if not key, area of support and resistance. That's where we ran into some support once again, despite briefly nipping below here. We've rotated higher off these levels. We'll see where today ends, but if we end, and again, depending on which textbook you read, these tend to have their own, people tend to have their own ideas of what this means. Potentially got a morning star formation here. Morning star being when, and again, depending on the textbook, if we close above the midpoint of the first candle of the three, or if we close above 2/3 of the size of the candle of those three. It's open to interpretation. I prefer it when it just does it above both, because that obviously gives a potentially stronger signal. I prefer it again if we can break it, close above the open. But you can't always get your own way in these things. But a potential rotation setup on these 110s could be quite bullish, especially considering it coincides with the cloud formation as well. And it's something that was previously nicely bullish. But again, if we are in a vulnerable market right now and we're going to see more periods of risk aversion, there is potential for the yen to go through a good phase. Sterling yen is as wild as ever. What I found really interesting here is we've got this big double top formation with around 148.50s around the top, and we've got this support area here around the kind of 144, 144.50s. We held up here on the last two occasions, and we've rotated higher. If we fail to make a new high here, then all of a sudden this area again once comes very much into focus. Simply, I'll remove this rising trend line. That's probably just noise at this point. But this area does come into focus because with every failed high attempt to the upside, the pressure potentially builds to the downside, which could trigger a potentially aggressive break below in the event that we actually see that. But of course, we're going to potentially be looking at two opposing factors here, potentially looking at a Brexit deal, which is a sterling bullish event, and potentially also looking at general risk averse markets if this yield curve inversion continues to weigh, which would be a yen strong event. So that'll be an interesting one to see how it plays out, and I think the technicals here could be a strong indicator. Finally, euro yen very much weighed down by the weak German data, the impact it could have on the European economy, for example. We are still finding support here around the kind of 124s. We've rotated higher today. For me, this looks like consolidation, a pairing of losses from Friday. So this still looks quite bearish to me. I wouldn't be surprised to see another run at the downside. If we look at this on a 4-hour chart, for example, we may see something like a rising wedge formation or a rising channel. It probably looks more like a rising wedge at this stage. So as far as I'm concerned, I'm looking at a chart like that, and that looks bearish for me near term. And again, if we break through these kind of late 123s, 124s, we are taking out a long-term support area here. You could even probably just take this back to around here. Not maybe, I mean, that looks quite extreme. It looks like a wide gap, but this is long-term support here. This is the kind of support zone that we've seen for a considerable amount of time. And for the sake of 100 pips here, this is clearly an area where every time we've tested these levels, we've rotated higher. So there's no point in ignoring it just because it's a slightly wider gap. Not ideal, of course, and you can always widen it or reduce it as per what it is that you want to do and what you're looking for. But for me, if I'm looking for a significant bullish or bearish signal, then I'm paying attention to that entire area. And if we're rotating into that area again, I'm looking to see, are we gathering momentum or are we losing momentum going into a key support zone? And I think for me, that could potentially give an indication as to whether we're rotating higher on the back of this or breaking below. Okay, I think that's everything really. We've got no questions and we have run over, so I will wrap things up there. I hope you all found that very interesting, insightful, or just you took anything away from it. And apart from that, I guess I wish you the very best of luck with your trading. You will be able to find the recording of this on YouTube and on the Market Pulse website later. I'll also post it on Twitter, LinkedIn, and elsewhere. Please do check out all the other content which we have on offer on the Market Pulse website, and also the podcasts which we put out twice a week. Oanda Market Insights on a Friday and Oanda Market Beat in the middle of the week. For the Friday one, with a look at the week ahead, and the Market Beat with an assessment of how things are developing over the course of the week. But apart from that, again, I wish you all the very best of luck with your trading. I'll hopefully catch you again soon. Thank you very much.